Yeah. So in terms of your single family strategy, am I right to assume that like your goal there is to just hold them extremely long term? Like it's something that you're just looking to create some wealth generation for the family and just have these properties that you kind of hold long term. They're not meant to be transacted or to turn around, like you just buy and hold.
You're absolutely right. Although that doesn't mean that I have not exited it. I
Of
did
course. Yeah.
exit my multiple properties because it made sense based on the amount of how much time I was putting in and
Right.
how much
Yeah.
return it was giving me.
Hey, fellow savvy real estate investors. Thanks for tuning in today. We have Anjesh Dubey on the show today, and Anjesh is joining us from the sunny San Francisco Bay Area, where I would probably like to be right now. He is he's got an interesting background because he's a tech professional working in, I'm sure, a high sort of stress, high profile industry, which is the tech industry down in Silicon Valley. But he's also a real estate investor, which is why he's on the show today. He has an impressive track record, managing properties both as a GP and an LP, and they have accumulated several hundred units. Obviously he's got a story as to how he started in real estate, what kind of investments he first started with, and really what led him into this multifamily space of syndications. And I'm sure started with more of like an LP and more of a passive investment, but now he's also made it more of an active investment, being a general partner on several of his own deals. So I'll let you tell us a little bit more about that and how you juggle all these different things. So Anjesh, thank you so much for being on the show. Maybe you could tell our listeners a little bit about your background, and what you do for your daytime living, and what really motivated you. I mean, I know you work in tech, you work in Silicon Valley. What motivated you to even think about starting to look into an alternative stream of income or real estate as an investment?
Yeah, absolutely. Thanks for an amazing introduction, and thanks for having me here. Really great to be here. I work as a tech professional here in San Francisco Bay Area, as you mentioned, and that's my day job. But how did I start in the real estate? I have to take you back in the past, really, because as we all know, it's real estate investment is not super straightforward. So how it started for me and my wife is back when we were very young. So for myself, when I was really young, my grandfather, when I reflect back, he was actually a multifamily operator. So he had this big apartment building. He rented a 15 unit. He lived in one, and he rented 14 others. Now, when I look back, I'm like, what I was observing there was that apartment building and the rental income from there, what he getting was supporting his retirement. So he was like traveling around, visiting us, visiting his grandkids, visiting his other cousins, and going all around in the country. And I'm like, how he's able to do it? And really, he was getting his mailbox money, no matter where he is, he's getting that rent and income. So that really put a pointer in my mind, and I didn't think much about it. But when I grew up and I moved to United States, so I grew up in India. And when I moved to the United States, after my studies and all that, when I got my first job, me and my wife saved enough. And the first thing we did was a real estate investment. And we bought a land. And now we think of it, we didn't run any numbers. We didn't do any cash on cash. I didn't understand any really metrics on around it, like what is IRR? What is this? We just like, hey, we got to buy it. And we didn't even think about it, like, why are we buying it? Like, oh, everyone buys real estate because that's how you build wealth. And from there on, like every couple of years, we saved enough, did it again, saved enough, did it again. And that's as we have been doing it for the last 14 years. And from there, then we moved on to the multifamily real estate. So yeah, that's like I wanted to give a background story on how that mindset allowed us to be. We didn't go through any coaching or anything or any real estate courses or anything. It's like it was just how we grew up. We were always interested in the real estate.
Oh, that's amazing.
Cool. And so, yeah, I have a question about that. You started with land. So what do you mean by land? Like it was just a raw land, and what were you going to do? Were you land banking, or were you going to develop it? Like what was your plan? And then the subsequent properties after that, were they all land as well?
Yeah, great question. Yeah. So with land, I think again, as I grew up in India, the land is most valuable part there.
Yeah.
So that appreciates like crazy there. Uh, it's the other way around. When you build something on it, it depreciates in value because in general, like over here as well, when you have something, it has a depreciation, but it's even higher depreciation in India. But if you have land, that is hard to come by. So when I was growing up, my dad, my grandfather, they are always looking for like land somewhere and then just leave it alone like that. And then maybe build it or just sell it like years later because it has appreciated. So like that's how I understood it. And that's how I'm like, okay, if I want to do a real estate investment, probably just buy a land. But when I did that, I'm like, that is not cash flowing. It's not giving me
Yeah.
anything. It
Yeah.
did appreciate for sure. And I still have it like 14 years later. I still have that land. And that's like now 6 or 8x now in price if I sell
Wow.
today. But we didn't do anything. But now there is like a giant community around it. All the houses have been built. So I have this just one land piece, has nothing on it, but everywhere else is like a giant community. And then because of that, now everybody wants that. And because of that, it appreciated. But
Where is
from
it?
there, it's in India, actually. That's right where my family lives.
Oh, I see. Okay.
And then the state is called Madhya Pradesh.
Oh,
So
I see. Okay.
yeah, yeah.
Oh, very
That's so
interesting.
cool. Yeah. I've never heard of anybody who started with land. So you're the
Right.
first one, but it obviously worked out for you.
Yeah, definitely. And from there, I think we're like, okay, we need to get back into the cash on cash kind of like buy something that produces cash. And that's when we started investing in right here in California. And from there, it was all condos, duplex, triplex, single family homes. And then we expanded ourselves to multiple states as well remotely.
Yeah. So tell us a little bit about your journey through like, what you learned through, I'm assuming you were self-managing some of these smaller properties, duplexes and single family. What were they kind of just get an idea on the price point and how much income you'd get? And what kind of made you go and look at other states?
Yeah, so I don't self-manage any of these really. So we always believe in that in our time. So if we assumed it that if we are going to expand further, we need to have a professional property management team.
Okay.
And no matter where it is, we just hire a good property manager. I vet them personally, meet them, and try to find out what their track record is. And sometimes if they don't work out, then also change the property manager accordingly. Yeah, the certain criteria, I think for California, it's a little different compared to when you invest outside of California. California is a pricier state, as we all know. So over here, it's more about breaking it even. That means that if all my expenses, including mortgage and all the other expense cost, is covered by the rental income, is good enough because of higher appreciation in many years, 7 to 10 years. It brings and adds value and adds to your net worth. But if I'm investing outside of California, then I'm looking for a more higher positive cash flow. And that's something 7 to 10, I mean, a few years ago, up to 7 to 10% cash on cash return. If I'm investing 100,000 of my, then I'm looking for 7,000 to 10,000 a year in cash flow
Right.
after paying all expenses and everything. So yeah, that's how we ventured out as California continued to get pricier. So the entry point is getting harder and harder, and the cash flows keep going down. And at the same time, we wanted to have some positive cash flow.
Yeah, you
Right.
sound like our investors here because
Yeah.
Toronto is exactly the same. So
yeah, exactly.
we went through the same exact journey. Like when we started investing in 2009 to 2012, when we were aggressively, really starting and buying single families, it still made some fundamental sense. Like you could still cash flow a few $100 and like things were okay, right?
And
now,
then we switched to duplexes.
Yeah, duplexes, because again, you're getting strapped with the singles, right? So like, okay,
Correct.
maybe 2 units is going to create some cash flow. But
Yeah.
now here in our market too, especially with interest rate changes, I mean, either the interest rates are high or the prices are high, one of the two, right? So
One
it's
of the
all,
two, yeah.
it all at the end of the day, the cash flow is not there. So it's definitely a tricky market, and I understand that. So that's why even here, I think our listeners, a lot of our Ontario listeners can relate in that you have to start seeking opportunities outside of your home, because fundamentally, based on your investing goals, it just doesn't make sense, right?
Yeah. And I really, much later, I found out a quote that, I don't know, somewhere that, hey, live wherever you want to, but invest where it makes sense, right? And I didn't know about that quote at all, but like how we transitioned from like California, and then we're like, hey, it didn't make sense. Let's start looking at somewhere outside, even though it's remote. It's risky because we can't see property, what's going on, but we ventured into that riskier and took that risk. And I'm glad that we did, because that gives us a lot of experience, connected with many people, and then also diversified across different markets, because each economy is a little bit different if you go.
Yeah. So tell us what state you chose and why that specific state after you left investing in California.
Yeah, so I always had some criteria, and then do some spreadsheets and all that, like look at it, census data, population, where are people migrating, where it has been growing, what are the areas has good schools, where does families would like to live, what are the appreciation has been in the past 10, 20 years for certain areas, are how much the communities average income is and what their rents are, so that we can correlate that whether they will be able to pay this rent or not. And how are they keeping the properties, like talking to property managers, hey, in this area, do you see a lot of high cost of turnover when they leave, or do you find it that when they leave, the property is in relatively good condition? So that allows me to find out that what price point I can go in, and if I can seek a certain return or not. So because of this criteria that I created, a lot of states qualified, like back in 2014, 16, 17, when I bought these properties, and like in North Carolina, Charlotte, Kansas City, Michigan, Dallas, like all of that started making sense. That's where people are going. That's where people want to live. It's still affordable. Pricing is still cheaper compared to California, and then it still can cash flow. So these criteria allowed us to invest a little bit, keeping it ourselves conservative, and also pick a good areas and neighborhoods.
Oh, that's excellent. So were you buying, again, single family homes in these areas? And maybe give us a kind of a breakdown of the last deal that you did with buying it as a single or duplex.
Yeah, these were smaller units. Yeah, so all of from single family to quads, all of these were. And last I bought it was in 2021 in Raleigh, North Carolina, and multiple of those. It made sense at that time. The appreciation and a lot of the good neighborhoods, and a lot of tech professionals were going there as well.
Yes.
So a lot of population increasing in that area.
Definitely.
It has a really good universities as well around. So a lot of good education hub there. And I found a really good property manager there with the help of the broker that I work with. So I network around, like, hey, I get a broker, and then found out referrals from there, and then get property managers, and then ask property managers, like, hey, who are the vendors that you work with? And then I vet those vendors. So just like connecting dots from there, and then you have a team built right there. Then you have a broker, you have a vendor, you have a property manager, and now even though you are remote, it's fine, right? You can call them up. It's like, hey, something problem, or this is not happening, or am I getting this notice? Like, they will take care of it for you, and now you build a relationship from there over the years.
For sure. Yeah, no, that's I see that you're a very sort of methodological person. Like you sort of work in a very thoughtful way, and I think that's really great. And I mean, it's interesting. So you were still buying like up until last year. And what were these? These were like single family homes?
Quads.
Quads. Yeah. These are like single families to quads, and been buying till 2021. So not last year. Last year I ventured completely in multifamily. Once I noticed that this is more scalable, way of doing things, what I've been doing so far.
Yeah. So in terms of your single family strategy, am I right to assume that like your goal there is to just hold them extremely long term? Like it's something that you're just looking to create some wealth generation for the family and just have these properties that you kind of hold long term. They're not meant to be transacted or to turn around, like you just buy and hold.
You're absolutely right. Although that doesn't mean that I have not exited it. I did exit my multiple properties because it made sense based on the amount of how much time I was putting in and how much return it was giving me. So I exited some of those properties. But really, you're right that I believe in a perpetuity model that just buy it and then it brings really the time is really of the essence. It's like buy early and then just keep it forever. And then as long as you don't have to put time in there, it has infinite return, right? Really. So here is an example. Like I bought a property in 2014 in California, put $100,000 of cash and 25% finance, 25% down and 75% finance. Fast forward 6 years later, it appreciated enough. I did a refi, took out 100,000 back. I have no capital in there now involved there, and then it is cash flowing. So even if it's giving me $1 positive, that's an infinite return because I do not have any capital in there. It is I have taken out that money and invested in other places, right? So and that is making money now, and this property is just there and adding value on its own without having me anything in there.
Yeah, absolutely. We call it the BRRRR here, right? Buy, rent, refinance, or buy, renovate, rent, finance.
And then keep it.
And then long term, it just it creates wealth just by sitting there, right? And the mortgage pay down and the appreciation. If it is appreciating, it's just you're right. It's absolutely wonderful. So I mean, it sounds like things were going good. You were diversifying. You were picking other states. You were able to you still be able to manage your own time. So you had property managers doing a lot of the legwork. What made the switch into thinking, okay, like now I need to go into multifamily? And obviously it's a completely different beast. It's a completely different model and there's a lot of different learning that's involved there. So tell us how you made that transition. What did you join a coaching program? Did you educate yourself in some way? Did you somehow connect with somebody who was doing this? And how did you kind of make that transition?
Yeah, it took some time for the research to make that decision really, because we looked into it that, hey, we have been doing this. And in 2021, we did it quite a bit. And then I exhausted myself, like, wow. And then it's not that I added quite a bit of units in terms of the doors and rent. It was like 9 to 10 units. And I'm like, okay, that took me an entire year to just do that. But that's not scalable. Like I can't, because I am doing search, I'm doing financing, closing.
And I'm assuming these properties, were they 100% owned by you, or did you still have like small partners on them?
No partners, just
no partners. Okay.
Yeah, so just myself and my wife, and then we did everything. And then there are so many steps involved, right? From like finding property to closing and getting a property manager is just like quite a bit of a work. And because of that, like, hey, if you want to continue, then me and my wife talked and sit down and like, if you want to continue doing this every year, we want to make it scalable. Like this is not scalable. This is started even researching and like after till property management, okay, yes, I'm free. But up till that point, that's a lot of work as well. And then we need to be able to make it scale faster. So like, how are other people doing it? And then also we started looking into that, how we can utilize some of these tax benefits because of my Google searches started popping me up like, hey, you have a good tax benefits in multifamily. I'm like, what does it mean? Having a tax benefit and investing in multifamily. So that's really attracted us because one of the problems living in California with working in tech professionals is like we live in the highest state income tax in the United States. And along with federal tax, we are in a high tax bracket along with other people who lives here in our family and friends. So we started looking, hey, how does multifamily investment can solve this? And in the same year in 2021, we started like, okay, let's try this as a limited partner, investing it with someone. How does it work? And then we did that multiple times with multiple sponsors. And it started giving us a really good tax benefits. Like, wow, it is generating a really good cost segregation depreciation for us that can minimize some of these future gains. It's like, okay, this is a total new area that we have not explored in the past. Let's do it. So we took our time, 6 to 8 months, did quite a bit of a research, and then we realized that we cannot go this alone, like by ourselves. This is a large step that needs to be done with some guidance and with some coaching. So that's when we joined a mastermind that helped us into pushing us in the direction that we wanted to go. And like, hey, how does this entire model works? How you can actually purchase a large multifamily apartment building along with working with the different investors and operators. So that was really useful. And that's how we started into it.
Yeah, no, that's amazing. And so when you invested in the as an LP, a limited partner in as a passive investor, what were some of the, I would say benefits of doing that versus, and what made you switch to, hey, you know what, let me look into being a general partner now?
Yeah, so as I mentioned, I think that is in relation to our interest and mindset, right? As I told the story about how we are like deep into the real estate, and then first thing we did was buy real estate and land. We always wanted to be active in real estate. So the passive gives us a good experience, like tax benefits and like, okay, freeing our time and everything. But then our keen interest towards being actively involved in them, we are like, hey, if we are passively investing it, we understand this and we want to be also actively involved in it because we are good that in this experience and skills that we have achieved in the last 14 years working remotely, buying so many properties. Why don't we utilize our skills and experience to actually become active in buying large, say, multifamily apartments? It's not too much different. It's just a little bit more. And but you are not doing alone. So we are like, okay, this model makes complete sense. We are not by ourselves. There are a lot of people involved. We can leverage their expertise and then bring our expertise to them, what we are good at it. And we are like, okay, this is a win-win model. It's not a zero-sum game anymore. And that makes total sense for us. So it's like, because of our interest, we moved there.
Right.
Yeah, that's awesome. So, I mean, talk to us about what it means to be a general partner. Like, in what capacity are you guys operating? Are you bringing capital to the deal? Are you finding the deal? Are you helping to manage the asset? What role do you play in most of the deals that you are involved in?
Yeah, so we started with finding out how to vet operators, what deals do they have, what risks are associated it, and what areas they are in. So pretty much utilize the same skill set that we had before in buying single families, and now applying it to the vetting the operators who already has a deal either in a contract or they are looking for. Once we go from there, like, hey, this deal makes sense, this location makes sense, and the value add that we are going to do in this makes sense. We are agreeing with your business plan. Then we raise capital for them. So in the last year, 2022, we raised capital for multiple operators. And once it closes, then we got into the management part of it, where the team is working with property management, and we got on the asset management calls regularly to find out what is going on. And then we utilize that information to pass on to the investors to say that, hey, here is the stuff that we did so far. If you have any questions, and sometimes they do, and then we bring back to the general partner team and get answers for those, and then relay back to the investors. So that's the role that we are playing.
Yeah, for sure.
Yeah, and my next question was about the way this market is changing, right? In the last say 10 months or so, when interest rates started to hike up, how has your when you were raising capital as a general partner, tell us some of the challenges that you were faced with, and how you overcame them.
Yeah, that's super interesting question. So I think this is not easy for anyone at this point to like understanding. First of all, I think for the people who have not invested in real estate before, I think it's even harder to overcome that risk or even uncertainty that's going on to go and invest 50,000 or 100,000 right away into a deal which could be locked down for multiple years. Yeah. So I think it's more about coaching. So it's like, if coaching and the goals that investors have. So anyone I talk to, now they know that I invest in multifamily apartments. They're like, hey, what are you doing? How does it work? What can you tell me more about it? So I always go with like, yeah, I can tell you more about it, but first you tell me what are your goals are, like what is your interest is in. Like this may not be a right fit for you if your goals are different. You want your cash to be liquid because you have a wedding coming along for your daughter, or you have a higher education that you have to spend on your kids in the next couple of years. This may not be a right fit. But if your goal is to continue to build wealth and keep investing, and gives you tax benefits, and that you're not worried about that, hey, whether this investment, if I lose this investment, I'm still fine. It's hardly happens that you lose in real estate, but even if that happens, I'm really fine. So if your goal is like that, you can take that risk, then I can tell you more about it, right? So I think going with the investors with their goals, like what do they want to achieve it, and then how does this multifamily investment can help them, is how I target the investors and help them achieve that.
Yeah, and how do you attract investors? I mean, you have a corporate career, so how do people know what you do? Are you, just people, friends, family, and colleagues? Is it just sort of word of mouth growth? I know a lot of people struggle with this. I think people who are in corporate careers, because their entire identity is not real estate.
Yes.
They're not always talking about real estate and doing real estate. So it's a part of what you do, but how do you convey that to people that, hey, this is something I actively do, and this is something that I'm looking to raise capital for?
Yeah, that's a very good question. I think you are absolutely right. And I've been in the corporate culture for like 14 years and plus. And so that's what my identity has been. But now what I'm doing is I'm also telling the story of the other side of it, because yes, I've been in the corporate culture for 14 years and that's what my day-to-day job is. But for the 14 years, I'm also being a real estate investor, right?
Yeah.
So what I'm doing is organically telling that story, that it's not something that I started yesterday. It's something that I built the experience and skills over a period of time, in a long time. And now I'm utilizing that experience and skills to this model. So I'm bringing a value to everyone. Right. And the reality is that I think the most value that I feel that this model brings is the tax benefits and that is not available in really any other form of investment, not in stocks, not in even in a single family investment, because you can't afford a cost segregation there. So that's something is the value that I do. Word of mouth, meeting, and organically helping people.
Yeah, and it doesn't hurt that you live in one of the highest tax states in the country. So
exactly,
everybody there is probably. So tell us, what are the taxes typically in California? Like, what's the range of taxes you guys pay?
Yeah, so we pay 12, depending on the tax bracket, it goes from 10 to 14%. Just for the state. And then federal, we have another, it can go up to 37%. So if you're in a high 37, so if you're in a high tax bracket and you're paying the top federal 37, any extra dollar you earn via your earned income, you're going to pay up to 50 to 52% of so you're pretty much $1.50 are gone in taxes and you're left with only 50 cents. So
we're the exact same here. I think our highest tax bracket is about 45% here too. So
yeah, 45 to 50.
45 to 50. Yeah. So people here feel the exact same way. And we have high taxes too. Our HST, which is on all purchased goods, is 13%. And our property taxes are,
property taxes, I would say, are not as bad.
Not as bad.
Maybe
10% of value.
No, more like 3%.
Really?
Yeah.
Okay, maybe. I don't know what it is. Well, percentage.
I guess they don't get reset like the way that California does. When you buy a property, you're basing it on that's the new appraised value.
Correct.
Here, it's a little bit lower. So that's the advantage. But yeah, my other question was, you've been very, very active. Obviously in the real estate space, you've acquired a ton of units individually, and now you're doing as a general partner raising capital. How are you able to juggle all of this? Plus you have 2 kids, a wife, and to look after. So how are we able to juggle so much while still continue to grow?
Yeah, it's definitely. I mean, I think it's a lot to do with I think over a period of time developing personally as well, along with having, I think, lot of credit goes to my wife as well. So whatever we decide on, we do it together. If any venture we are gonna do it, if any investment we are gonna make, if we are exiting from any investment, like we decide it together. So then we are more efficient. We are not going in and at different directions. It's moving it as a single wheel, marching towards our goals, right? So even though with that makes it super easy, but also then we prioritize things. I think that's where I think everything comes down to. We have, I believe we have a health to take care of, first of all. After that, we have a family to take care of. Then we both have work that we work full time. So we have a job to take care of. And then we want to take care of our investment business and our investors. So it all comes down to the priority. For every week, we lay down what are the few things we are going to do this week. There are certain things that needs to happen daily. For example, kids are going to go to school. We have to cook. We have to do a regular chore. That's going to happen weekly. So that is a side. Beyond that, now, whatever the time is available after the work, what is it we need to do? We need to prioritize our health. We need to prioritize investment and business. Like, what are those tasks? Like, really drill down to like call this person or do this, write it down, and then prioritize in advance 1 to 2 weeks. This is going to happen, and then yes, there will be thrown offs in between because it's going to go sick, and you are sick, or something else comes up, right? So it throws us out of our target, out of our schedule. But I think what we do good is we come back to it faster. So fail fast, but then come back to it, what you have decided upon on, and then just start marching again in the same direction. So priority, priority, priority. I think that's how we want to lay down our entire week, so that week is not driving us, we are driving the week. And I think that's helping us to make things happen slowly but steadily. I think that's what is my message, is like do consistently, even if it's a smaller thing every day.
Yeah. No, that's really good advice. And, it's 100% true that time expands, right? Like if you give yourself the whole day to accomplish something, that's how long it's going to take you. But when you only have this much time, like you have to go to work. So when you come back from work, you only have like 4 or 5 hours of productive time. You give yourself 1 hour to do it, and you have those key things that you got to do in that hour, then I think you're absolutely capable of getting them done. If you give yourself the entire week to do it, it's going to take you the whole week to do it, right? So definitely some good advice there. And
and then you know what, this is a great message for our audience too, that you can't give yourself any excuses, right? Everyone has a busy schedule, and too many people make the excuse that, hey, I'm going to do it tomorrow, procrastinate. They want to watch Netflix rather than working on their business, right?
No, and I think because you're a corporate professional, like a lot of corporate people are like, no, because I can't do it because I'm focusing on my job. I'm focusing on my career. You can still focus on your career. You're going to make some other sacrifices, like you said, like how much TV you watch, or how much time you go out with friends, or, how much time, maybe you don't get to go to bed early tonight because you have these things that you have to get done. So you have to stay awake an extra hour, whatever these other sacrifices are. But there's no such thing that just because you're focused on your job, which obviously you're very committed to your job, you've had a long lasting career and still managed to continuously grow this other side of your life, or this other side of your business. Right. So
makes sense.
There's no, oh, I can't do it because I, and ultimately, like you said, like time fills with you can fill it with whatever you want, but the time's still going to pass, right?
Right.
Yeah, I know that's really good. So Anjesh, tell us, I mean, it sounds like you're just getting started. I mean, you just now into this multifamily, and I have no doubt you're going to do something fantastic with it. What do you have going on now, and what is the next few years looking like for the business? What are you guys cooking?
Yeah, definitely. Yeah. So I think this year is going to be different compared to the last few years, as we all know about different economy. Also, I think even a different economy here in California, because this has been a tech heavy, and the technology is having some challenges in terms of economy because the companies grew faster, and now it's just facing certain headwinds. So it's going to be different. We are observing everything. We are looking at all the data points. Where is the market going? What are the value? What's happening to the valuation of the real estate? But we are not sitting on the sidelines. I am actively looking for finding a next opportunity, and our goal is to be cautious, but not sit on the sidelines. So, because during the uncertain times, only you have opportunities that you will not ever find ever. So in 2008, a lot of people sit on the sidelines, but who remained active, they saw the benefit of it. And that's what we got another opportunity this time around. And our company is not going to sit on the sidelines, but we are going to be very, very cautious. We are going to be very, very strict on our criteria. We are going to be very strict on which asset class, what kind of property, what kind of sponsor, what kind of operators, what kind of property managers we are going to go with. So we are going to vet the entire team very strictly, and will only go in if it makes sense for me, my investors, and for our company. And it's based on the values that we have. And if it meets those values, then only we are going to partner and then go ahead with that.
No, great answer. And you know what? It's so true. Like this time you gotta be not sitting on the sidelines, but that's actually there might be some great opportunities coming ahead, as long as you're conservative though. Because it's not like you can just ride out the market where we had last couple of years with the rent growth. There's going to be very, very asset management is going to be very key.
Operations is going to be key here. You're right.
Yes.
Partnering with the right operators is going to be integral to the success of. Now it's going to be an operator's market, right?
Yes, you have to execute a business plan. Yes.
Yeah.
I mean, it's always been about operations, but now more than ever, the ones who are going to come out afloat are the ones who know how to operate these deals, not just because the market has ridden, right? Like in the last couple of years, we ourselves saw that people were exiting deals and they didn't even do anything to it, and the market just rode it, and to their favor, right? Because of what the market did. And I mean, that's great, but the market can't be like that forever. So now we're seeing some tougher times. And so the strongest are going to win.
Yes, that's absolutely true.
Yeah. So I think that, we're almost at an end here. Just before we wrap up, I wanted to ask you, is there sort of a quote that you wanted to share with our audience, something that resonates with you, or something that you live by that is kind of your motto, or a quote, or something you'd want to share?
Yeah, I think I would say, and the reason is I recently read a book because of that. Like, do hard things first, and don't. I know it's going to be challenging. Whenever you learn something new, whenever you find something new, it's always going to be hard. But as you do it, you will reflect back and say, like, oh, that was easy. Well, things didn't get easy. You just know more about it, and that's why it feels that it's. So always choose that instead of an easy stuff, do the hard things first. And the book name is that I read through is same line, Do the Hard Things First by Scott Allen. So it's exactly about that topic of procrastination. That do not procrastinate. If you decided on like, hey, this is what I want to do not sit on it. Take action and do a small steps, like very, very small, even if it's minor. You will feel like that you are not making any progress, but you are, because you started something and then you started doing something. And whether it means that learning about investing, that's in itself is a step.
Yeah, and then before we wrap up, there was a question like, is there any specific deals that you're working on right now? Currently raising capital for, or is it something you're still, I guess, vetting for a right opportunity?
Yeah, so I'm very actively waiting for the right opportunity, not raising capital for any deal actively. But if anyone, to your audience, if anyone hear this, reach out to me directly. I have some good models in the works right now that can act that I mentioned earlier is the perpetuity model, so that I'm working upon. And it's going to be a really good model that I believe for my investors. So please reach out and I can tell you a little bit more about it in one-on-one to how that works.
Awesome. So yeah, if people do want to get in touch, we'll put it in our show notes as well. What's the best way that they can reach you?
Yeah, the best way is to reach out via LinkedIn. I'm very active on LinkedIn. So linkedin.com/Anjesh Dubey altogether. You can message me, DM me there right away. You'll get a response. And my website is dubeyinvestorgroup.com.
Yeah.
Okay, fantastic. We'll make sure we link it in our show notes. So Anjesh, thank you again for taking time out of your, I'm sure, very busy day to come on our show today. I think it was a really, really nice conversation. And I hope we were able to inspire some other folks who are potentially in a position where they're maybe corporate professionals, or maybe they're single family investors who are looking for a way to scale, people who may want some tax benefits. There's so many things that we talked about and so many great nuggets. So I think that our listeners will definitely get a lot of value from our conversation today.
Thank you so much for having me here. I really appreciate your time as well. So I really enjoyed our conversation here. Thank you.
Awesome.
Thanks, Anjesh.